The transparency, the openness, the communication is more than you could expect. I'm sold.
Don't let the fact that you don't know something or don't know enough about something hold you back.
I knew I wanted to invest. What better way to invest than to invest in what I already know that I love, which is real estate?
It was initially the 12% return, but it quickly turned into the people.
Hi, and welcome back to another episode of the Multifamily Masterclass. I'm Bart Diehl, and today I'm joined by two awesome guests, John Kobierowski and Amanda Schwicht. The last podcast we did, we talked about our latest acquisition venture on Colter. We talked more about the financial side of things and the property management aspect, how we plan on operating the property. Today, we're going to talk about the property itself, the location, and distress. So, John, I'm going to kick it off. Can you give us a summary of what is happening with distressed assets, maybe nationally and here in Arizona? And then, do we still think there's going to be more distress in 2025?
So, interesting thing. We knew that there'd be some things coming about. We knew that these things would start popping up. And it's a good thing that lenders have been very quick to work with their borrowers, and they've extended loans, and they're working around it, and they're giving borrowers more opportunities to fix loans. We've also seen a lot of preferred equity come in and bridge the difference between new workout loans and the existing loans. So they're solving problems. But the short story is there hasn't been a lot of distressed. There's stressed, but as far as distressed, this is the only bank-owned asset that I'm aware of right now in the metropolitan Phoenix area, as far as multifamily of size. So Colter is one of those deals that we got our hands on, but not to dive into that too quickly. But as far as the market, there's just not a lot of stuff. A statistic I keep talking about is that we've had 33 sales of apartment buildings over 100 units in the metropolitan Phoenix area this year so far, and this is mid-December. So 33 sales. Of those 33 sales, 27 were new build projects.
Wow.
So 6 were existing 100-unit plus projects in a whole year.
Yeah.
That just tells you how slow the volume is of sales and how the market's just kind of frozen.
What's like comparable data to that, like in 2022, 2021? And I know you don't have to have it.
No, I can tell you because it's a common conversation.
Yeah.
The best way to say it is in 2021, we were selling is a market 30 to 40 buildings like that a month.
Wow.
And keep in mind the 33 sales of 27 that were new build. The only reason why those new build buildings went on the market and were sold is because the developer leased up the property, finished it, leased it up, looked at it and said, can I refinance it? And the loan quotes probably came back because of debt coverage and the higher interest rates that could cause the debt coverage differential. It probably came back on a $30 million property, $5 million short. And the developer goes, oh man, we're $5 million short. I'll be able to cash out our construction loan. Our construction lender's, pushing on us saying, hey, pay us off. So they have no option but to sell. And with that said, our construction costs, labor, materials, land costs, none of this stuff's gone down. Land's not gone down a bit. Land's going up. Certainly construction costs and materials gone up.
Yeah. So not a lot of distress in the market, but there is some stress going into 2025. How did Colter specifically come onto our table, come onto our radar? How did we get this deal? Do you think we'll see more deals like Colter next year?
So we got lucky with Colter. It was something that ABI had on the market. We understood the asset really well, knew the last two owners very well. It wasn't a failure of the property. It was a failure of the loan and the lender. So the lender that was on the property, well, not even the lender, it was a failure of the situation. It was the rate cap expired. The interest rate bumped up. The borrower, the owner, said, I can't continue to pay this higher rate. And they handed it back to the lender.
And with this property, didn't we look at it a few months ago when trying to buy it from the previous owner?
We toyed with it, yeah. We got it. So we got a little bit more of a discount to the price. Mm-hmm. And and they cleaned it up. They also cleaned up some of the payables that were on the property.
Yeah.
Okay.
So we got lucky on the building. But again, do I think there's going to be more things coming to the market? Absolutely.
Yeah.
Do I think there's going to be more situations presenting themselves? Owners that are feeding properties that are going to give up on that? People that they're going to have to go back to the partners saying, hey, we got to restructure? Absolutely. It's just one of those things that has to happen.
Yeah, and talking with Jameson and past conversations with you, there's buildings similar to Venture on Colter that we've looked at And if it goes back to the lender, it's definitely something we will consider. But right now, Colter's been the only one, and it's been a great start with the first acquisition in the opportunistic fund. But staying on the topic of venture on Colter, what do you guys like most about the property?
Well, I've known that property for a long time. So what I would not have liked about the property in the past is what I kind of like about it the most now. The location, for most people who are been residents in Phoenix for 10 years or more, they don't recognize that location as a good location. What people don't realize is that GCU, Grand Canyon University, has become a Goliath of an institution. Amazing institution, done some amazing things, and they're a great neighbor. In fact, I just saw today they just restructured $520 million of their outstanding debt with some IDA bonds. That's amazing too, because they got a great credit rating on those bonds because of their stability and their ability to continue to provide a great value for education. But with all that done, that neighborhood is now really stable. And someone might look at it and go, well, there's like these 3 trailer parks around it. Yeah, those are all my friends of mine, really close friends of mine. I know the parks. I understand what's going on.
Yeah.
They're not bad parks. So what I like about it now is the location, but I wouldn't have liked it 10 years ago. Unit mix, gosh, I'd like to have more 2 bedrooms, but then again, it's a master meter property, so I'd rather have smaller units. And for me, I think the value of that property over time is going to play out for us because we're buying it on a low price per pound, a low basis. It was well renovated by the current owner. There's things that we need to do down the road, but nothing that is glaring on the property. And I think over time, it's all about a management play.
Yeah, and
That's what it comes down to.
And just to piggyback off John, so people know, we're acquiring this property for $13 million, which is the debt value of the building today. The original value of this building was around $18.5 to $20 million. And the previous owner spent $2 million in renovations for the property. So about $5 million of built-in equity. On top of that, there was really good renovations already done. Can you talk about some of those renovations?
And smart renovations.
Yeah.
Going through the list of renovations, you can see where they put money. They spent $46,000 on air handlers in the chiller system. Those are the individual fan coils inside of each unit. That's great. They replaced a whole bunch of those. We're probably going to do some more over time, but they took care of the worst ones. They upgraded and fixed the gas piping on the property. They upgraded and fixed a lot of water lines. They did an amazing job on the courtyard and exterior. It's well gated. They changed with the leasing offices onto the main street that faces more of GCU's property, which is a good thing for us. So all these things that they did are going to benefit us. What are we going to probably do down the road that I kind of hinted at? I'm not entirely happy with the way the kitchens look and feel. They're not very functional. And I think the last owner did a good job of putting the money towards the big ticket items, $2 million towards those big ticket items. But, we would have reworked the kitchens, new cabinets, countertops, a little more functional bathroom setup also. And these are not big cost items, but we'll probably attend to that and kind of see how that affects our rentability over time.
So outside of, potentially maybe doing some renovations to the interiors of the units, what else is there to enhance the value of the building? I know we talk about property management all the time and operations. What's kind of the strategy there?
Just running it better and getting higher rents. So what would be the perfect scenario on this property? Interest rates drop, 100 to 250 basis points is going to shoot the value up like everything else in the market. Our rent's going up naturally because we haven't had real sizable rent increases in Phoenix for 2 years, but we're starting to see some of it creep in. Occupancy, getting it to and keeping it above 95% will help. And then just the whole idea of addressing some of the smaller things about that property that just, I don't know, there's nothing horrible.
Yeah.
I like the paint. I like the fact the roofs look good. The parking lot looked good. The gating was done correctly. The dog park works. The pools are nice. We just got to run it consistently on 95% occupancy or better.
Yeah.
Something I want to hop in there is I remember when we were doing the tour, one of the things we learned from the in-place property management team was the fact that a lot of the tenants were long-term ones. They were consistently renewing, so that property has a great retention of its tenants right now.
Yeah.
And that's not what I would expect. I didn't expect that in that neighborhood, those size units, master metered, and you expect more turnover. But I think it's because of the value proposition. I think it's in that area with the amenities afforded to it by GCU.
Yeah.
To put it in perspective, if this property was right up against ASU or horseshoed around ASU, Arizona State University, horseshoed around it, you have all the benefits, security, services. We even saw guys pushing, like the old-fashioned street sweepers, guys pushing garbage
GCU
cans.
students.
Well, they could have been. One guy might not have been, but he had a bicycle with a sweeper front on it, picking up garbage around the area. I mean, that's the kind of benefit we have. But yeah, I agree that the retention is amazing on that property.
Yeah.
And the tenants seem to be very involved and very concerned about what was going on. And I think if we have reasonable rent increases, I think we'll maintain those tenants. And you could tell by the cars, you could tell by the units. We went into every single unit. One of them had 5 dogs. That was the one unit that I was like, but the rest of it looked good.
Mm-hmm.
Yeah.
So we're talking a little bit about the area. There's GCU. What else is there in the surrounding area that helps, rent growth, demand for multifamily housing? What supports our strategy here in the area?
Again, this is the I-17 corridor.
Mm-hmm.
It's definitely seen its worst times. There were some heydays back in the 70s and 80s, maybe partly in the 90s, but definitely the last 10, 15 years, the area's fallen apart. Metro Center Mall is being renovated. That is a big, big thing. That is a massive piece of land and a big part of the city. And don't forget, we're also on Silicon Chip Freeway because I-17 connects basically the Taiwan Semiconductor down to all their suppliers and to Intel. And we're going to see a ton of people that are going to be in product moving up and down the I-17 to support that project. And I think those things all tie in. We're going to continue to see more and more improvements. The light rail now comes across at Dunlop, right near the Metro Center Mall. Mm-hmm. I think the last neighborhood that to be kind of upgraded over time is probably McDowell or Thomas, south of McDowell and south from there to the Broadway curve. I think that area is going to have to get improved at some point. But it's really nice big industrial buildings, rail served. These are things that benefit the area and create a lot of employment.
Yeah, it's over 100,000 people per year move into Phoenix. A lot of folks moving here for TSMC jobs or these industrial jobs are going to be living in that I-17 corridor. So we're well positioned for people to be living in Ventura on Colter and moving into Ventura on Colter in the near future. Just to close this out, what would you guys say, I'm going to put you on the spot, is one key takeaway you want our investors to know about this project?
I think the biggest takeaway for me is always the built-in equity. Like Bart said, we're getting it for $13 million, but it's been valued at around 18 to 20, and so that's over $5 million in equity already on this. So that's a great deal. It's easy. I imagine it's going to be easier to sell in a few years, just because it's a great asset, and we're going to be putting in that time on it.
Yeah.
I mean, we don't have to do much to move that needle.
Mm-hmm.
And is it hard to get back up to that value? No.
Yeah.
The number one constraint we have in our valuations in the Phoenix market is debt coverage, DSCR, debt service coverage. It's not the cap rates. It's not how the property's operating. It's not occupancy. It's not condition. It's not even potentially what someone will pay for it. It's basically what loan dollars you can get against a property based on its ability to support that debt. And because interest rates are higher, it's hurting values. So one little bit of movement in interest rates, which tomorrow, speaking of things,
an update.
Fed meets tomorrow, so we might see a 1/4 point drop. Not sure how much that actually flows through to us, but I think these things are going to continue to help our market.
Thank you for listening to our podcast, The Multifamily Masterclass. Please subscribe to get all of our new episodes.